stock market crashes. Right now, as you're watching this, stock market is getting hit pretty hard. The fear gauge on the other one, the VIX, is drifting around 16. The headlines, the portfolio is red. Everything isn't fine. I want you to hold on to that feeling for a second, because here's the uncomfortable truth this whole hour is built on. Every single great crash in market history was born in a moment that felt like this one. In 1929, an economist named Irving Fisher, one of the smartest men alive, said stock prices had reached what looked like a permanent high plateau. He said weeks before the market fell 89% and took 25 years to come back. He didn't just lose his reputation, he lost his house. So, this isn't a doom video, and I'm not here to tell you the sky is falling. I'm here to do something more useful, to teach you the anatomy of a crash. How they actually start, what really causes them, who ends up holding the blame, and the part that matters most for your money, what 100 years of history tells us about what happens next, and how you can position for a range of outcomes instead of betting everything on one. We're going to walk through 5 crashes that rewrote the rules: 1929, 1987, 2008, 2020, using only real numbers. And then we're going to turn the whole thing around and point it at today. By the end, you'll never look at the green portfolio the same way again. Let's start with the news, because context is everything. As I'm talking to you today, the NASDAQ, who was down more than almost 2%, is down less than 1%, and the Dow is down 0.5%, and the S&P is down 0.75%. And volatility is still very low. The VIX, the fear gauge I mentioned, is sitting around 19. I mean, it did spike toward 23 earlier this month, and then there have been a couple of ugly days driven by worries about AI spending and a sharp sell-off in semiconductor stocks, but it settled down and dip buyers showed up like they always do. Under the surface, though, there are 3 things that should have your attention. Not because they guarantee a crash, but because they rhyme with history. First is concentration. A handful of giant technology and AI names are doing a huge share of the heavy lifting. And a few stocks carry an entire index. Market gets fragile in a way that line numbers hide. Second, policy. The Federal Reserve under Chair Kevin Walsh has been signaling it's willing to raise rates again rather than cut. Markets are starting to price in a potential hike. Higher rates are gravity for risky assets. And notice this, because almost every cash we're about to study had a central bank tightening into it. Third, complacency. Gold ran a record above $5,600 back in January and has since cooled towards the low 4,000. Oil spiked on a Hormuz scare this spring and has collapsed near to $70, just to go back up around 80 again. So let me give you the texture of the moment, because it matters. Just a few days ago, we closed at the highest, and now we've been dropping quite a bit. Fourth thing humming in the background too, the dollar. The US dollar share of global reserves has been slowly drifting down toward the psychological floor, around 50%, as countries quietly diversify into gold and alternative. That's not a crash trigger by itself, but it's part of the same picture. A financial order that was rock solid for decades, developing airline cracks while the stock market looks the other way. Now, I want to be honest with you about uncertainty here, because that's the whole point. None of this is a prediction that we crash next week. In fact, I don't believe we're going to crash. Markets can stay expensive and come for a long time. The job isn't to call the top. The job is to understand the machine well enough that when the music changes, you're not the one caught standing. So let's open up the machine and understand what's happening. This is about education, about what a crash is about. And this is a great opportunity to learn what's going on right now, to understand it. Because when it happens, and it will, not yet, but it will, once all the pieces are together. And that's why I created the Black Swan. Once that is done, once I've uncovered the Black Swan, I will move on. But we're not there yet. We're waiting for it. What I'm talking about is 10, 15, 20% drawdown, not 3, 4%. That is what it's about, looking for the black swans. So Let's get our definition straight because people throw these words around. A pullback is a small dip, a few percent. That's just the market breathing. A correction is a drop of 10 or more, 10% or more. A bear market is a drop of 20% or more. And a crash is something different in character. It's a silent, it's a violent, fear-driven collapse, usually compressed into days or weeks, where selling feeds on more selling. Here's a key idea I want you to carry through this whole video. A crash is not really an economic event. It's a human one. It is a social phenomenon. A feedback loop where one person selling scares the next person into selling, which scares the next person until the exits get jammed. Markets go up with the staircase and go down with the elevator. And the reason is psychology, not spreadsheets. So remember, up with the staircase, down with the elevator. Now, let me give you the cleanest analogy I know. A crash is a bank run. Picture a perfectly healthy bank. If a rumor spreads that it might be in trouble, everyone rushes to pull their money out at once. And because no bank keeps all its cash on hand, the rush itself is what makes the bank fail. The fear becomes the fact. A market crash is the same machine. The belief that prices will fall causes the selling that makes price fall. The legendary investor George Soros gave this a name, reflexivity. The idea that what we believe about the market actually bends the market. On the way up, optimism creates the gain that justifies more optimism. On the way down, fear creates the losses that justifies more fear. The crowd's mood just doesn't react to reality. It manufactures it. Now look at the chart behind me. This is a real Dow Jones from the 1920s into the 1930s, and I'm using it to show you the 5 stages that every bubble's moved through. Almost 90 years of crashes, and they all follow this same rough script. Stage 1, displacement. Something genuinely new and exciting shows up. Radio and cars in the 20s, the internet in the 90s, AI today. Smart money moves in early and they are usually right. Stage 2, you get the boom. Prices rise, the story spreads, more people pile in. And of course, stage 3, you get the euphoria. This is the dangerous part. Valuation stops mattering. People buy because prices are going up, and prices are going up because people are buying. Your barber is giving you stock tips. That's the top of the chart, right there at the peak. And of course, you got stage 4, profit taking. The smart money that got in early quietly heads for the door. And stage 5, panic. Something, anything, pricks the bubble. And everyone tries to leave through the same door at the same time. That is the cliff you see on the right side of the chart. Now, here's the accelerant that turns a normal decline into a crash. Leverage, borrowed money. In 1929, ordinary people were buying stocks on 10% margin, meaning they put down $10 and borrow $90. That's fantastic on the way up. It multiplies your gains tenfold. But on the way down, it is a death trap because when prices fall, your lender demands his money back immediately. That's a margin call. And you are forced to sell into a falling market whether you want to or not. Forced selling prices drive prices even lower, which triggers more margin calls, which forces more selling. Leverage is the gasoline. Fear is the match. And that is where our first framework earns its place. Chaos theory. You've heard of the butterfly effect. The butterfly flaps its wing. Markets are a chaotic system in exactly that mathematical sense. Tiny inputs can produce enormous, unpredictable outputs. A single bankruptcy, a single bad deadline can cascade into a global panic, not because the trigger was big, but because the system was fragile and tightly wired together. That's why nobody can reliably predict the day of a crash. The system itself makes precise prediction impossible. What we can do is measure fragility. And that's what the rest of this time that we're going to spend together is really about. Take a look at this chart. This is 1929, the Roaring Twenties. America had just won a war. Factory was humming. The 3 brand new technology, the automobile, the telephone, and the radio were changing daily life. The economy was genuinely strong, and that's important because it's what made the speculation feel reasonable. Look at the chart. The Dow climbed from around 63 in 1921 to a peak of 381 on September 3rd, roughly a six-fold gain. Ordinary people, school teachers, shopkeepers were pouring their saving and borrowed money into the market. By that summer, hundreds of millions of shares were being carried on margin. The whole thing was a house of cards held up by leverage. Then it broke. On a Tuesday in early September, a financial forecaster named Roger Babson warned a crash was coming. The market wobbled. Through October, the cracks widened. Then came the bad days with the famous names. Black Thursday on the 24th, Black Monday on the 28th, down nearly 13% in a single day, and Black Tuesday on the 29th, down almost 12%. Some stock had no buyers at any price. And here's a part people forget. October 29 was not the bottom. It was just the beginning. The market kept grinding lower for nearly 3 more years. This is where it's a bit different from 1987, is that 97 you draw, and this was 20% in one day. Never had that in the past and never had it since then. That 1929 was 13%, but then the market kept grinding lower for nearly 3 more years, all the way down to 41.2 in July of 1932. From peak to trough, the Dow lost 89% of its value. If you had $100,000 at the top, you're not left with anything. And this is the hardest part. It did not go back to even until November of 1954, 25 years later. So who's responsible, right? The speculators who treated the market like a casino. The brokers, they're the one responsible, who handed out margin loans like candy. And the Federal Reserve, which first get money too easy, fueled the mania and then tighten into the weakness. There were almost no regulation, no rules about disclosure, no referee on the field. Companies could lie about their numbers and nobody could stop them. And that is the lasting legacy of 1929. Not the crash itself, but the rule book it forced into existence. The Senate Pecora Commission dragged Wall Street's biggest name in front of camera and exposed the rat. Out of that situation came the Securities Act of 1933, which forced companies to tell the truth in writing before selling a stock. The Glass-Steagall Act of 1933, which has been repealed since then, which built a wall between boring deposit banks and risky investment banks, which was removed since then, I think in the 90s. And the Security Exchange Act of 1934, which created the SEC, the cop on the beat that still policy markets today, and which completely missed out on Bernie Madoff in 2008. Remember that wall, Glass-Steagall. It's going to come back and haunt us in 2008. The deeper lesson of 1929 is one Irving Fisher learned the hard way. The market can stay irrational and confidence can stay sky high right up until the second it does not. Certainty is the most expensive emotion in finance. I always tell that to my members. And please become a member and also a subscriber. You should know that you never know. But I'd be doing you a disservice if I left out the economic context, because the crash didn't cause the Great Depression by itself. The two fed each other. As the market collapsed and people lost their savings, they stopped spending. Businesses cut jobs. Banks that had loaned money against stocks began to fail, and 9,000 of them over the next few years. And back then, when a bank failed, your deposits simply vanished. Federal Reserve, which should have flooded the system with money to stop the bleeding, did almost the opposite. It let the nation's money supply collapse by roughly 1/3. That policy mistake is now considered one of the greatest economic blunders in history. And it's the single biggest reason 1929 became a decade-long catastrophe instead of just a brutal year. The Federal Reserve, my friend. That is why every year, and every Fed chair since Greenspan, Bernanke 2008, Powell in 2020, has answered every crash by doing the exact opposite. Printing fast. They are all, every one of them, still fighting the ghost of 1929. Keep that in mind when we get to today. And ask the uncomfortable question, what happens the next crash if inflation won't let the Fed print? Right? Because what we're saying is we're going to lower the rates. If you lower the rates, you are basically pushing up inflation. But if inflation is already there, push it even further up. Think about that for a second. And while you're doing that, let us go to 1987. Fast forward 60 years to a crash with a completely different cause. And it teaches the opposite lesson. October 19, 1987, Black Monday, and it was a Black Monday. In a single traded day, the Dow Jones fell 580 points. That is 20 in one day. To this day, it is the largest one-day percentage drop in the history of the American stock market. Nothing in 1929, nothing in 2008, nothing in 2020 was worse in a single session. Look at the chart. See that vertical red cliff? The market opened at 2,246 and closed at 1,700. The S&P fell over 20%. $500 billion evaporated in hours. And here's what makes it so unsettling. There was no Great Depression behind it. There were no bank failures that morning, no obvious reason. The economy was basically fine. So what happened? This is where chaos theory stops being abstract and gets terrifyingly real. The culprit was a piece of a financial engineering called portfolio insurance. I mean, the idea sounded smart, right? Big institutions use computer programs that would automatically sell stock index futures as prices fell, supposedly to protect themselves. The problem is that everybody was running the same program. So when prices dipped, the computer sold. The selling pushed prices lower. The lower prices triggered the computer to sell more, which pushes price lower still. This is your feedback loop. This is your butterfly effect with money. A small initial drop got mechanically amplified into a 22% collapse, with machines feeding the fire faster than any human panic ever could. The system wasn't brought down by bad news, it was brought down by its own wiring. Now, who was responsible? There were no greedy speculators this time. The engineers, the people who built tools to manage risk and accidentally built a machine for manufacturing it. The deep lesson of 1987 is that complexity is its own kind of danger. When everyone uses the same clever strategy, the strategy stops working and often does the exact opposite of what it promised. But here's a twist, and this is the hopeful one. 1987 looked exactly like 1929 on the day it happened. A bigger one-day drop. People genuinely feared another depression, and it just didn't happen. The new Fed chair, Alan Greenspan, flooded the system with cash and made one short, calm statement that the Fed stood ready to support the markets. Confidence held. The market clawed back most of the loss within 2 days and was at new within 2 years. Same looking event, opposite outcome. Why the difference from 1929? Because by 1987, we had the referee, we had the SEC, we had deposit insurance, a central bank who knew its job was to be the lenders of last resort. The regulation born from the first crash contained the second. And out of 1987 came one more tool we still have. Circuit breakers, automatic timeout that halt trading when the market falls too fast. Giving panicked humans a few minutes to breathe. You'll see those circuit breakers at work in 2020. And I want you to sit with the 1987 lesson because it's the most relevant one to 2026 that nobody talks about. Today, more money than ever is run by machines and by passive index funds, all programmed to do similar things at similar time. We have arguably built a bigger, faster version of the exact same wiring that snapped in 1987. The flash crash of 2010, when the Dow fell nearly 1,000 points in minutes and recovered almost as fast, was a preview. When everyone's algorithm is told to sell if everyone else is selling, you don't have a market anymore. You have a hall of mirrors. The speed of modern markets is a wonderful feature on a calm day and a loaded weapon in a bad one. Let us go to the dot-com bubble. Now, to a crash that could feel uncomfortably familiar in 2026 because it was built on a real world-changing technology and a story that ran away ahead of reality, the dot-com bubble. In the late 90s, the internet arrived and it was genuinely revolutionary. But investors stopped asking whether a company made money and started asking whether it had a dot-com in its name. Add a .com suffix to your business and your stock could triple overnight. Companies with no profit, sometimes no revenue, went public and soared. The NASDAQ, the tech-heavy index, went vertical. Look at the chart. From around 759, the NASDAQ rocked to a peak of 5,000 in March 2000. The index price to earning ratio, basically how many years of profit you're paying for, hit 200. To put that in plain terms, imagine buying a pizza shop and paying $200 for its profit up front. That's not investing. That's a lottery ticket with a logo. That is where game theory explains the madness. There is a concept called the greater fool theory. You don't buy the overpriced stock because you think it's worth the price. You buy it because you believe a greater fool will pay you even more for it tomorrow. And as long as everyone believes that, it's actually irrational to keep playing. You make real money. It's a game of musical chairs where everyone knows the music will stop, but everyone is sure they'll grab a seat in time. The catch, of course, is that when the music stops, there are no chairs at all, and everyone reaches for the exit at once. And stop it did. The NASDAQ fell 78%, bottoming around 1,100. More than $5 million in wealth, $5 trillion in health evaporated. The poster child, the bets.com web van, went from market darlings to zero in month. And here's the number that should sub up anyone who thinks tech only goes up. It took the NASDAQ 15 years to go back to its 2000 high in 2015. Now, who was responsible? Well, the investment banks that hyped garbage company into the market to collect fees, the analysts who put buy ratings on stock they privately mocked, and honestly, all of us, the collective willingness to believe that this time the old times and rules of value didn't apply. The four more expensive words in finance, this time it is different. This time it's different. 4 words. The regulatory response came after the accounting scandal that followed. Enron, WorldCom, companies that had simply lied about their numbers. Congress, passed the Sarbanes-Oxley Act in 2002, which forced CEOs to personally certify their financial statement and face prison if they lied. It made corporate fraud a lot more dangerous. Now, I'm not going to pretend you can't hear the echo, right? An incredible new technology, a story that justifies any price, a handful of names dragging the whole index higher. Swap internet for AI and you got 2026. Doesn't mean we are the 2000 top. The biggest AI companies today actually earn enormous real profits, which the dot-coms never did. But the psychology, the greater fool dynamic, that's the part of history that always rhymes. And let me add the economic context here. Before the dot-com crash, it wasn't just psychology. There was a real world bust underneath it. Telecom companies had borrowed hundreds of billions of dollars to lay fiber optic cable for an internet that was growing fast, but nowhere near as fast as its bet. They have built far more capacity than the world could use. And when the bills came due, giant like WorldCom, Global Crossing collapsed. Meanwhile, the Federal Reserve had been raising interest rates 6 hikes about a year, draining the easy money that had flooded the whole party. Notice the pattern repeating, a central bank tightening into a bubble. Here's a survivor's lesson, the one that should keep AI investors humble and hopeful at the same time. Amazon, a real company, still fell from around $100 a share to about $7. Cisco, the company's building the internet plumbing, fell almost 90% and stayed below its bubble peak for over 2 decades. Being right about technology did not save you from being wrong about the price. You could have predicted that the internet would change the world, bought the best company, and still almost lost everything. Let that one sink in for a second. Now, if this framework is useful, the full version lives inside being a member. Premium tier with scenario dashboard, 10 separate tools that I provide for you and help you decide what is important. I do a daily live every day. I do trades detail. Whenever I do a trade, I'll let you know. I bought it this week, by the way. I do live weekend updates, investment cheat sheets, regime change update number one. Then for the titanium, I also do, and I do chart of the day. And then for titanium, I add prediction markets analytics, black swan lake deep dives. Where are then our past trades? More regime change update and black swan interview. And of course, let's talk about the global financial crisis, 2008. For most people watching, this is the big one. The crash that defined a generation, cost millions their homes and jobs, and nearly took the entire global financial system down with it. The story starts with something that felt as safe as anything could: your house. The belief was simple and universal: houses' prices always go up. So banks handed out mortgage to almost anyone, including people who clearly couldn't repay them. Those were the subprime loans. Then Wall Street did something clever and catastrophic. They took thousands of these shaky mortgages, bundled them together, and sold the bundles as supposedly rock-solid investment. The rating agencies stamped them AAA, the safest grade, and then banks insured the bundles and insured the insurance until the whole system was a tower of bets stacked on the foundation of loans that were never going to be repaid. And here's the game theory heart of it: a real-world prisoner's dilemma. Every individual bank knew the system was getting dangerous, but no single bank could afford to stop. If you stopped making these loans while your competitors kept going, you'd lose business and your CFO would be fired by Christmas. So everyone kept dancing, even knowing the song would end badly, because the cost of stopping first was higher than the shared cost of the crash. Typical prisoner dilemma. Individually rational, collectively suicidal. That's the trap that builds almost every bubble. Look at the chart. The S&P 500 peaked at 1,500 in October 2007. The defining moment. Then the mortgages started defaulting and the tower began to wobble. The defining moment is that dashed line. September 15th, 2008. When Lehman Brothers, a 150-year-old investment bank, went bankrupt. The government let it fail, and confidence didn't just crack, it shattered. Banks stopped trusting each other entirely. Credit froze. The financial plumbing of the world seized up. The S&P fell all the way to 677 by March 2009. Now, was 2000 the black swan? This is the perfect place to define the term, because the man who coined it, Nassim Taleb, argues it actually wasn't. A true black swan has three features. It's a massive impact event. It's almost impossible to predict. And afterward, everyone explained that it was obvious all along. For most people, 2008 was a black swan. It came out of a clear blue sky. But Taleb's point is sharper. The system had been engineered to be fragile, stuffed with hidden leverage and risk nobody could see. The handful who looked closely, like I was, saw it coming and made fortunes. So 2008 is really a lesson about hidden fragility, risks that are invisible right up until they're catastrophic. Who was responsible? Well, this one has a long list. The banks that made loans who knew were bad. The rating agencies paid by the same banks that blessed the garbage as gold. The regulators who looked away, and crucially, the deregulation that sets the stage. Remember Glass-Steagall? There was a war between boring banks and risky banks. Built after 29, it was repealed in 1999 with the sign-off of the Fed. Within a decade, the exact disaster it was designed to prevent happened again. History doesn't just rhyme, sometimes it photocopies. The response was enormous. The government bailed out the banks with hundreds of billions through the TARP program. The Fed cut rates to zero and printed money, and in 2010 came the Dodd-Frank Act, the biggest financial overhaul since the 1930s, forcing banks to hold more capital. Whether it's enough, we don't know until the next storm tests it. I don't want to leave 2008 as just a number on a chart, because the human cost is the whole point. This wasn't an abstract market event because about 9 million Americans lost their jobs. Millions lost their homes to foreclosure. Retirement savings built over 30 years were cut in half right as people were about to retire. And here's the part that still makes people furious and that you need to understand as a matter of game theory. Almost none of the bankers who built the machine went to prison. In fact, no one went to prison except for one. The institutions were judged too big to fail, meaning, if they collapse, they'd take the whole system down. So the government rescued them with taxpayers' money, while ordinary families were left to drown. That creates what economists call moral hazard. Keep the profits when your bets win and the public covers your losses when they lose, then taking insane risk is a rational move. Heads I win, tails you bear me out, until that incentive is truly fixed. So the seeds of the next 2008 are planted in the response to the last one. And let me just say something about the Fed here. You notice that the Fed was a culprit in 1929. The Fed was also a culprit in 2008, right? They allowed this to happen. In fact, they hold the Federal Reserve chairman on Congress and they ask him, were you wrong? Take a look at it. It's on YouTube. And he says, well, I was wrong because I assumed these people know what they were doing, but you were in charge. So watch for the Federal Reserve. They could be very helpful. And to that end, I'm quite positive that they have seen, the same way you're seeing and I've seen now with this video, what needed to be done. And they did it. In 1929, they didn't do it. But they did in 1987 and they did in 2008. Basically, you need to flood the system. So therefore, it's unlikely that they will allow, even if you have a crash, to get worse, at least to flood the money with liquidity. But can you do it while inflation is going on? That is a question. So next, let us take a look at COVID. That's the one we all lived through together. February 2020. The market was at an all-time high. The economy was strong, and a virus on the other side of the world was a back-page story. This is a real black swan, right? Genuine, unpredictable from a market standpoint, enormous impact, and obvious only in hindsight. Look at the chart, and look at the speed, because speed is the entire story here. The S&P peaked at 3,300 on February 19th, and the whole world locked down. And in 23 trading days, barely a month, the market fell 34%. Try to put that in perspective. In 1929, it took almost 3 years to find the bottom. In 2008, it took about 17 months. In 2020, it took a few weeks. It was the fastest collapse from an all-time high into a bear market in the entire history of the stock market. The selling was so violent that those circuit breakers were invented after 1987 actually fired, trading altered across the whole market multiple times in a single month. The VIX, the fear gauge, that's around 19, exploded to 80. That's raw, undiluted panic. And here's what makes 2020 the most important crash to understand what comes next. Look at the right side of the chart. The recovery was almost as fast as its collapse. Why? Because the response was instant and gigantic. The Federal Reserve cut rates to zero overnight and created trillions of dollars to backstop the markets. Congress passed trillions more in stimulus. The full weight of the government landed on the market in weeks, not years. And the S&P was back to an all-time high by August, 5 months after one of the worst crashes in history. So who was responsible? Nobody really, and that's the point. You cannot blame a speculator or a bank for a pandemic, which teaches the final crucial lesson. Some crashes you simply cannot prevent or predict. They come from outside the system entirely. You can't forecast a black swan. You can only build a portfolio and a life that can survive one. And notice the new pattern 2020 cemented, because it matters enormously for your money today. The modern crash playbook is fast crash, massive policy response, fast recovery. That's been the lesson of the past 2 decades. But by the panic, trust the Fed. But I want you to hold the lesson loosely, because every crash teaches investors a rule, and the next crash usually punishes the people who learn it too well. In 1929, the rule everyone had learned was that dips were for buying, right up until the dip ate them alive. If inflation is high and the Fed cannot ride to the rescue, The fast recovery playbook might be the most expensive assumption you carry into the future. And what we have proof that the bill comes due, because it always does, and that money printed and edited out in 2020 didn't disappear. It showed up 2 years later as the worst inflation in 40 years. To fight it, the Fed had to do the one thing it spent a decade of voting: raise rates hard and fast. The result was the 2022 bear market, where the S&P fell about 25%, and bonds, the supposedly safe asset, had one of their worst years in history at the same time. So the real lesson of 2020 isn't just the Feds always save you, it's that the rescue has a price tag. And the price arrives on a delay in a form you didn't expect. The medicine for one crisis becomes the cause of the next. That is the machine. It never stopped turning. Okay, so we've walked through 5 decades that took completely different on the surface. Different decades, different causes, different villain. Now, let's do the thing that actually makes you a better investor. Let's find what they all share, because under the hood, they are running the same engine. Look at the first chart. The drawdowns line up side by side. 1987 down 37%. COVID 34, right? And towering them all, the 1929 down by 89%. Everyone blew through that 20% bear market line like it wasn't there. Big declines are not rare freak events. They are recurring, permanent feature of how market works. If you invest for 40 years, you will live through several of these. Guaranteed. Now, the second chart. Recovery time. And this is the one almost nobody internalizes. COVID came back in 5 months. In 1987, 2 years. 2008, 5. Right? In 1929 to 25 years. Here's the brutal math behind those bars. A drop of 5% requires a gain of 100% just to break even. A drop of 50% requires a gain of 100%. A drop of 80% requires a gain of 400%. The deeper the hole, the exponentially harder the climb, which is why avoiding the catastrophic loss matters infinitely more than catching the perfect top. So what's the shared DNA here? Well, across all 5, I see the same 4 ingredients every single time. 1, leverage, too much borrowed money hidden somewhere in the system. 2, concentration, too much money crowded into one story, one sector, one trade. 3, complacency, volatility low, confidence high, risk forgotten. And 4, the trigger, some spark that flips the crowd from greed to fear in an instant. And notice something important in the first 3 are the dry firewood as they build up slowly in plain sight over years. The 4th is the trigger, is the match that is essentially unpredictable. That's the synthesis of everything we've covered. Chaos theory tells us we can't predict the match, but we absolutely can measure the firewood. We can see leverage building. We can see concentration rising. We can see complacency in a sleepy VIX. And when all 3 are stuck high, we know the system is fragile, primed so that any spark, whichever one happens to come, can set it off. And that's one piece of shared DNA, and it's the most human one. It's why crashes are so violent and so fast on the way down. Think of it as a game theory trap. On the way up, investors' incentive is to stay in. The music playing, right? The gains are real. Nobody wants to leave the party early and miss the upside. But the instant fear hits, the incentive flips completely. Now the person who sells first loses the least. So everyone sprints for the same exit at the same moment. And the exit is tiny. It's a stampede, and it's perfectly rational for each investor, even in its catastrophic for the whole. It's the prisoner's dilemma wearing a mask, market clothing. What's smart for you alone guarantees a worse outcome for everybody else together. That single dynamic is why markets take the stairs up and the elevator down. The decline are always faster and more violent than the long climb that came before them. That reframes the whole job of a serious investor. You are not a fortune teller trying to name the date. You are a fire inspector. You don't know which match will fall. You just know how dry the wood is.